Right, okay, so they say there are two things that are certain in life: death and taxes, of course. So this is unfortunately something that we have to consider. The good finance minister spoke to us a few weeks ago, and he actually mentioned a few things that we certainly need to be considering as well, because they affect particularly the retirement decision. But there's so many things happening, and they're happening at the speed of light in this tax arena. Once upon a time, you just woke up, government took money, handed it over, and you carried on with your life. Now, it's very complex. And to unpack some of the information that came through from the finance minister, but also just generally the tax implications in the retirement space, to take us through that conversation, it's my great pleasure now to welcome from Alexander Forbes, Jenny Gordon, and she'll be chatting to Laura du Preez.
Well, isn't everyone on the Banting diet at the moment? So I had a good protein breakfast this morning. My mother in particular sees the moment. I think that every day is special. Android, I have to keep it in the family. I have two children. They're university students. Life gets me up in the morning.
Good afternoon. I'm back again, and this time, as Peter said, we're talking about tax, and it always gives me great comfort whenever we talk or write about tax to have an expert helping me to do that. And so it's my pleasure to have Jenny, Alexander Forbes' lawyer, with us today so that she can set us straight on the tax issues. Thanks for joining us, Jenny.
Hello, Laura, and hello to the rest of you. But Peter, before we start, I have to take issue with you. You said that the only certainty in life are death and taxes. I just want to make it clear what the difference between death and taxes are. Does anyone know? Okay, with death, you can probably negotiate an extension.
Thanks, Jenny. When you talk about tax, it's often a subject that people just feel the curtains come down and they think it's too complicated for them to ever get to grips with. And what I've found writing about tax over the years, that there are definitely some areas of it that are very complicated, but a lot of it is actually just a lot of detail and getting familiar with that detail. And I can remember feeling quite empowered after a presentation very similar to this one, and finally getting to understand when the deductions for tax planning apply, and realizing, yes, that it's just getting to grips with those details. And so I'm going to ask Jenny some questions today that I hope will give you that basic information in bite-sized answers.
Great, Laura.
So to start with, Jenny, why should I concern myself about tax planning for retirement?
Okay, we actually get this question a lot, Laura, and really, when one is looking at tax planning for retirement, one needs to look at it as really an exercise in efficiency. Okay, it's an exercise in efficiency that requires a little bit of knowledge that goes along with us. It's just really making sure that at every stage of the financial planning process in one's endeavors to save for retirement and within one's overall investment strategy, that one takes advantages of the tax opportunities that exist. Okay, one thing that I would like to point out, because we often have people coming into our offices and tax is the goal. Okay, I think that what we've heard today and what we're going to hear during the day is the goal is not tax saving. The goal is saving for retirement, making sure that one has sufficient retirement capital at retirement to give us sufficient income in retirement. It's one of the factors, the kind of factors that we have to think about when we are planning for retirement. We've got to look at inflation, we've got to look at inflation beating returns, we've got to look at the risk profile of a person, one's tolerance for risk. One needs to look at the portfolios we go into, investment performance. We need to look at our time horizon to retirement. And in addition to that, we need to look at how we can maximize things from a tax point of view. Because I think that it is actually clear that if we get the tax right, we can actually maximize our investment returns. Now, generally, Laura, there are two ways that we save for retirement. Okay, the one way is via retirement funds, and that is what we call pre-tax retirement planning, because the government gives us a deduction. Okay, why does the government give us tax incentives? Okay, whenever we get tax incentives, it really is a way of encouraging good behavior. Okay, and the government wants us to save, because if we don't save, we end up being a burden on the state at retirement. So it's a good goal, and we get those incentives. And they're incentives we need to take advantage of, because if you think about it, for every rand that we put into a retirement fund, with the new tax rates, the government is subsidizing up to 41%. Okay, it's really a situation, you don't look that type of gift horse in the mouth. You take it. There are so few tax deductions and tax concessions available for individuals left. Okay, so that when the government gives us some, we really need to take advantage of it.
Okay.
So that's really the one way and the primary way that we save for retirement. And it's really the way that we probably are going to explore a bit today. There are other ways, and what I would like to do is the other ways I would like to deal with in our future club sessions. So I invite you all to come to the future club sessions if you want more than a mouthful of tax. But the other way is your after-tax investments. Now, what we mean by this is that another name for it, we call it discretionary investments, is that you use after-tax money and you place it into different investment vehicles. Now, one needs to know a little bit about the taxation. Because, for example, you don't want to be in an investment that's going to be taxed at your marginal rate of tax, that's also not growing at a fast rate, or that is growing at a low rate, and some of that is also being shaved off for tax. You're not going to reach that goal of inflation-beating return. So it really is important that one has a slight understanding of it, which you get with the help of the financial advisor, as you've been told today.
Thanks, Jenny. And you've mentioned that there are opportunities at each stage of the retirement process. What are these stages?
Okay, so let's look at retirement funds. What are the stages? Okay, so we've got your contribution stage. We know that retirement funds are very efficient from that point of view because you're getting a tax deduction going in. Okay, then the next stage that you have to look at when you're evaluating an investment is the growth stage. What's happening to your money while it's growing in the fund? How tax efficient is it? Okay, because naturally, if you're getting a gross return in a fund, you've got a very good chance of your funds beating inflation and you're reaching your retirement goals. Now, in a retirement fund, it's extremely efficient because you're paying no tax on dividends in the fund, no tax on interest, and there's no capital gains tax. And in addition, when you actually leave the fund, the final demise being the death we were talked about, there's no estate duty at the moment in relation to what is in a retirement fund. Okay, then exit events. Okay, I think that we know that the most important exit event is retirement, and we know in a retirement fund we get many concessions on investments on your tax at retirement, which you might not get at a different stage. So those are the stages that one has to concentrate on in the main.
Okay, so if I'm starting to contribute to a retirement fund, what are those tax benefits that I enjoy when I'm contributing?
Okay, now at the moment, we've got a situation where we have a certain set of tax deductions. Okay, it's tax deductions that we have had for many, many years. And the good news is that these tax deductions are hopefully only with us for the next year. Okay, and why do I say hopefully? Because in actual fact, they're quite complicated. I think that probably you all know that there are three kinds of retirement funds. You've got a pension fund, a provident fund, and a retirement annuity fund. Your pension fund and your provident fund are the funds that you can be part of in an employment situation. Okay, the difference is that if you're in a pension fund, your employer can get a deduction and you can get a deduction of up to 7.5% of your remuneration. If you're in a provident fund, only your employer gets a tax deduction. And then if you're, for example, self-employed, or if you want to participate in a retirement annuity fund, the deduction there is only 15% of your income. So you can see, Laura, this is quite a complex scenario, which we hope will be changing soon.
Okay. You've mentioned that it's changing soon, but I seem to recall that it was due to change now this month, March.
Yes.
What happened to that change?
Truth is stranger than fiction in South Africa at the moment. We had legislation which had actually already introduced the changes from the 1st of March 2015. But I think it's important to actually understand what has been happening in the retirement environment in South Africa. The National Treasury is on a campaign of retirement reform. Okay, there are three main tiers. There are a number of tiers, but I'd say the three main tiers that they have delved into at this stage is firstly, harmonizing the tax deduction. They want to have one kind of tax deduction for all the funds, okay, which is a good thing. The next thing that they wanted to do, and which was supposed to come into play on the 1st of March 2015, is that they wanted to have compulsory annuitization of provident funds. You might know that currently if you retire from a pension fund, you can get only 1/3 in cash and 2/3 must purchase a pension. However, if you're in a provident fund, the full amount can come out in cash. Okay, now what they wanted to do is they wanted to create the same rules for provident funds as for pension funds. Okay, because I think that it's correct in the sense that many people get to retirement. It's the first time in their lives that they've ever had a large lump sum, and most people don't know how to manage large lump sums, which landed up being the cause of them actually being impoverished in later years in retirement. They landed up spending too much in the beginning and having nothing in later years. So Treasury intended making Provident Fund members also annuitize 2/3 of it. What they had done, though, is they had said, we understand that there's a concern about vested rights. People are entitled to have their vested rights, expectations protected. So they said that anything that exists up to the 1st of March 2015 will still be able to come out as a lump sum, and you will only have to annuitize into the future. Okay, unfortunately, there was confusion around that. Okay, because the other string in Treasury's bow, in terms of making sure that people had financial sufficiency in retirement, was that they wanted to introduce a form of compulsory preservation. Okay, now the date for compulsory preservation hadn't come out. It's still being refined, it's still being talked about. There's a very good chance that there'll never be absolute compulsory preservation, but many employees got confused. And so what was actually happening, and especially in the government sector, if people were resigning from their employment in droves just to get access to their retirement funds, really destroying their chances of financial sufficiency in the future. It was a very dangerous situation. So the unions and NEDLAC and the government got together, and in order to just stop this, they decided to postpone the introduction of the tax harmonization rules. And they've said that they will be introduced from the 1st of March 2016, but if they don't actually get any kind of agreement with the unions and basically lull them into a sense of safety, we might actually also be waiting until 2017. So that was a very long way of telling you what happened. Okay.
Thanks, Jenny. Yeah, from what I've heard, Treasury is going to embark on a big education campaign to make sure that everybody does understand properly those changes that are coming in.
That'll be a good thing.
And so if the tax deductions do change on March the 1st next year, how will they change?
Okay, so as I said, there's actually going to be a simplification which we are looking forward to. In relation to pension funds, provident funds, and retirement annuity funds, there's going to be one deduction. And the deduction will be 27.5% of a person's remuneration or taxable income, whichever is the higher. Okay. Now, the difference, though, between now and what's going to happen in the future, which will affect many people in this room, is that the maximum amount you're going to be able to get a deduction for in the future is an amount of 350,000 Rand a year. Okay, so if your 27.5% takes you to higher than that, the deduction will still be limited to 350,000 Rand. It's going to be the individual's deduction, not the employer's deduction. So if the employer actually still continues contributing to the fund, okay, the contribution will be added to the employee's taxable income, but then the employee will be given a concomitant tax deduction on the way in. So it all equals out. If one's in an employer fund, the 27.5% includes the cost of administration charges and life cover, so there's a little less going into investment. And another thing that they also introduced is that if you have just small amounts sitting in funds of up to 150,000 Rand, you'll be able to take those out as a lump sum, whereas currently the value is only 75,000 Rand. So I think, Laura, it's going to be a simpler process into the future, and we look forward to the implementation of this.
Okay. It's going to be a simpler process, but will it be beneficial for me?
I think that there is going to be a certain amount of beneficiality, for want of a better word, is that nowadays it's very, very complicated. I'm not going to explain the circumstances to contribute, for example, to a pension fund and then say to a retirement annuity fund. Okay, here you'll be able to spread your 27.5% much more fluidly. Okay, so you can have some of it funding your pension fund at work, and you can also top up with a retirement annuity fund. I think what is also a good idea is that one doesn't necessarily have to stop contributing when you leave employment. One can actually continue, if one has the resources, contributing to a retirement annuity fund, and it's quite significant. A deduction of 27.5% is quite significant. Just while we're on the changes that are going to take place, I'd like to just take you to another change that we saw changes that didn't happen on the 1st of March 2015. I'd like to take you to one change that did happen on the 1st of March 2015. I think that people in employment have always had to retire from their retirement fund when they actually left employment. Okay, when you reached normal retirement age, as they called it, you were obliged to actually annuitize. You could take a third in cash from a pension fund, and 2/3 had to purchase an annuity. Okay, now, it had been recognized that many people are leaving retirement at perhaps the age of about 60 and are not ready to retire. They might be embarking on other little ventures, and they don't really need the money from their retirement fund yet. So what has been introduced is that from the 1st of March, you don't have to retire from your employer's fund. Okay, you will retire from your employer's fund when you make an election to retire. So you can still actually stay a couple of years longer in that retirement fund and let your savings grow until the time that you want to utilize it. And I think that is a big and important change that came about this month.
And that's something that you do enjoy in a retirement annuity, but now it's coming in for occupational funds as well.
Absolutely. And this is something that people who are close to retirement need to discuss with their HR departments and perhaps with their financial advisors.
And Jenny, that limit of 350,000, that only applies to people who are earning quite a lot of money, doesn't it?
It kicks in at around about 1.2 million Rands worth of taxable income, so one can gauge it from that.
Thanks. And then, shall we move on to the build-up stage? What are the tax benefits for me in the build-up stage of my retirement fund?
Okay. I think that what is wonderful about the build-up stage is that there's just no tax at all. Okay, so we've now had this deductibility of contributions going in. So it's been the gross amount of what you've put in, which is going to be working for you. Okay, then that gross amount is then earning dividends, capital gains perhaps, income tax, and actually one is paying no actual tax on that. So it really is, it enhances the potential for growth within the retirement fund.
And then when we reach retirement, what are the tax planning opportunities for me there?
Okay. So basically this is the goal. The goal is to stay in the retirement fund, let the compound interest do its work with the help of no tax in the retirement fund until one reaches retirement age. Okay, then when you decide to retire now from the retirement fund, there are two ways that you can take your money. You can take your money in cash, up to 1/3, and 2/3 will purchase an annuity. Now you can see from that table on the screen that the first 500,000 Rand is tax-free. Okay, that went up last year in the budget to 500,000 Rand, which is relatively generous. Okay, and then there's a table of different tiers, and the maximum that you will pay tax on a lump sum is 36%. Okay, then any income that you get, because 2/3 has to purchase a pension, you will pay tax here at your marginal rate of tax. Okay, but remember, you've had a deduction going in, no growth, no tax on growth, 500,000 Rand tax-free, and you will pay tax at your marginal rate on your pension. But in actual fact, what we've seen with statistics is that most people's income at retirement and tax at retirement is lower than during their working years. Every year the tax rebates go up, the tax thresholds actually increase, and on a big chunk of one's income, one pays no tax. So you can see, Laura, it is very beneficial to save via a retirement fund.
Okay, thanks, Jenny. And we've spoken already today about the fact that a lot of people don't preserve their retirement savings when they change jobs. And it's obvious what the implications of that are, is that you spend the savings that you built up and then you're potentially not going to have enough when you retire. But there's a tax implication as well, isn't there?
Absolutely. I think that, as I said at the start, is that all the tax deductions encourage good behavior. And I think also at this conference we've heard that one of basically the limiting factors of sufficiency of capital from at retirement is really the fact that people just don't preserve. Okay, so now the tax angle actually encourages that same good tax behavior. And if one preserves when one leaves employment, then any transfer to another fund, whether it's a pension fund or a retirement annuity fund or your employer's new fund, is actually tax-free when you transfer. Okay, but if one chooses not to preserve and one actually decides to take that amount in cash, one can see that Treasury doesn't actually reward this behavior, because you can actually see that slide on the screen, and you can see that if you withdraw from a fund before retirement, you are going to be penalized from a tax point of view. Only the first 25,000 Rand is tax-free, as opposed to the retirement table where it was 500,000 Rand. And if one does a comparison, you can actually see that the tax on the first 1,050,000 Rand on the withdrawal table is an effective 21.42%. On the retirement table, it's an effective 12.42%, and the tax saving, or basically the tax penalty on the withdrawal table is about 95,000 Rand. So you will be paying 95,000 Rand extra on that amount of capital, okay, if you use the withdrawal table, if you basically raid your savings prior to retirement.
Sure, that's quite a big difference. Okay, so what happens to me if I'm retrenched and I need to live on that money?
You know, I think that what is actually quite gratifying is that National Treasury has acknowledged that sometimes people are forced to leave employment earlier and forced to sometimes actually take money from their retirement funds, such as a retrenchment situation where it's no fault of the member's own. And so in actual fact, if you are retrenched, okay, when you come out of your retirement fund, the lump sum that you can get on retrenchment is taxed on the retirement table and is not taxed on the withdrawal table. So if you are retrenched and you have to take some money from your retirement fund, the first 500,000 Rand will be tax-free. Okay. On retrenchment, though, Laura, is sometimes you get a sweetener from your employer we call it a severance package or a severance benefit in terms of the tax laws. Now, a severance benefit, okay, is also taxed on that same retirement table. And this is where people just need to be a little bit careful, because normally what happens is that the employer applies for the tax directive, okay, and you will get up to the 500,000 Rand tax-free for you until you find a new job. But if you decide to also withdraw from your retirement fund, remember you've already used the 500,000. In addition, later, if you, for example, have preserved your retirement fund and you come out and you retire, say from your next job, remember you've used your 500,000 Rand already, because all the tables are aggregated. So it's aggregated between severance benefits, between withdrawal benefits, retirement benefits, and death benefits.
So it's a bit of a lifeline, but don't use it unless you absolutely have to.
Absolutely.
Okay. And then what happens if I contribute more than I'm allowed to deduct in any one tax year?
Okay. I think this question is coming up more and more, and I think it will come up more and more when the 27.5% rate comes in, especially for people who have been contributing more than 350,000 Rand a year to their retirement funds. If you contribute to a retirement fund and you don't get the tax deduction that year, okay, you're not going to be prejudiced long term, because what's actually you've got 3 bites of actually getting a tax concession on that over-contribution. Firstly, if in the following year and the next years until you retire from the fund, you haven't used your full current contribution against taxable income, you can carry it forward. So that's the one way. Then, when you get to retirement and you take your lump sum, okay, you can use it as the first bite of your lump sum. So to take an example, let's say you have R1 million is your 1/3 coming out of your retirement fund. Let's say your over-contribution, which you didn't get a deduction for over your lifetime, was 500,000 Rand. Okay, and let's say you haven't used the retirement table yet. So the first 500,000 Rand is your over-contribution, which comes out tax-free. And then the next 500,000 Rand is the 500,000 Rand on the table. So you will get the full 1 million Rand out tax-free. Okay, so that was the second way. Then in addition, on the 1st of March 2014, they introduced a new section into the Income Tax Act. And this one is extremely useful for this kind of situation. If you make an over-contribution to your retirement fund, which is, in other words, it wasn't tax deductible, and you are drawing an annuity, or in the future you draw an annuity from any one of your funds, whether it was your employer fund or a retirement annuity fund, the over-contribution can actually be set off against that compulsory annuity income, okay, until the over-contribution is used up. So if your over-contribution is as much as the compulsory income that you are drawing that year, you can actually get tax-free income. Okay, the only thing that you do have to watch out for is that the administrator must take off the tax during the tax year according to the PAYE tables, and you've got to claim it back at the end of the year.
Jenny, what happens though to me if I die? What happens to my retirement savings and what taxes are deducted?
Okay. As we said, Laura, retirement funds are actually quite efficient from an estate duty point of view. So anything that's in your retirement fund, if you're still a member of a retirement fund and you die while you're a member, it's estate duty free. If you buy, for example, a living annuity and your dependents commute the annuity for a lump sum, estate duty free. Okay? The one thing that one needs to remember, though, is for one's beneficiaries, any lump sum that comes out from a tax point of view is actually going to be taxed as if it was the member's money before he died. Okay, so for example, if you have already reached the 36% mark on the tax table, it will be taxed at 36%, because it's not the beneficiary's tax, it's the member's tax. It'll be different, though, if the beneficiary chooses to take an annuity, not take a lump sum, but rather actually purchase a pension in their own name. Then it's not taxed in the member's estate, it'll be taxed as normal income for the beneficiary.
It's an important difference that people need to realize.
Absolutely.
Okay. And should I only save in a retirement fund, or should I also use other investments?
Okay. I think that at the start of this talk we mentioned it, and I said I would discuss this at club events. I think that we've seen from the statistics that pension funds, provident retirement funds are wonderful springboards. I think that there's been various bad behaviors over the years that people actually get to retirement, they haven't preserved, perhaps they've had years of bad investment growth, maybe the economy wasn't that great, maybe there have been high charges in the particular investments they were in over the years, and one possibly has not got to the replacement ratio that they have wanted. So therefore, I think that all along the way, one needs to be sitting with the financial advisor, assessing the situation, assessing whether one's on target, and supplementing with discretionary investments. Okay, looking at which ones are more optimally placed from a tax point of view, but I believe that retirement funds are a wonderful springboard, but they don't go the whole way, and one has to be supplementing every step of the way.
Okay. The government's introduced a new product, haven't they? The tax-free savings account. And can you give us a bit of an idea of how that works?
Okay, so this is the new thing from the 1st of March 2015. You've probably all been listening to radio adverts. Many companies are advertising the new tax-free savings account. This is another endeavor from National Treasury to encourage people to save. Okay? It's an account where you can save 30,000 Rand a year with a lifetime allowance of 500,000 Rand. It can be invested in a number of simple products, unit trusts, endowment policies, interest investments with a bank or any kind of interest investment. Your linked service providers are providing this kind of investment. And the beauty of this is that, unlike most other discretionary investments, the growth is completely tax-free. So you'll be paying no dividends tax, no capital gains tax, no tax on interest on the growth of this investment. And if one takes 30,000 Rand a year, it will take you just over 16 years to get to the 500,000 Rand mark. Okay? But it's a really nice little nest egg. The idea of this is that when you do need money, that you don't raid your retirement funds. Retirement funds need to be seen as almost like holy money, and if you need a little bit of extra, you take from the savings account. Okay, the warning is, though, that if you actually extract any money from the savings account, when you re-inject it, it has to form part of your 30,000 Rand. Okay, and you might ask, what happens if you put more in than 30,000 Rand? It's not a good idea, because they're going to tax you at a flat rate of 40% on the amount that you contribute more than 30,000 Rand a year. It's supposed to be small savings. It's supposed to just give you a little bit of extra savings, tax favored. Again, encouraging good behavior. That's the purpose of the tax savings.
And the other important difference is that this is after-tax money I'm saving in here as opposed to
absolutely.
The tax deductions on your retirement
Yes.
fund.
So really, almost if one looks at it compared to a retirement fund, where the retirement fund contributions are tax deductible, no tax on growth, but a certain amount of taxation at the end. With this, it's after-tax money, no tax on growth, and no tax at the end. Excepting what they haven't done is they haven't excluded it from one's estate from an estate duty point of view. That is really the only tax that still exists.
Great, Jenny, that's a great summary of all the taxes. Could you just give us one final guiding message on tax and saving for retirement?
Yeah, I think that generally, tax it's not difficult, but I think that one generally needs a little bit of knowledge when one is looking at one's investments and deciding where one should put one's hard-earned money. And I just believe that one really shouldn't go it alone. I mean, just as if, I think that every year one needs to go for a financial checkup with your advisor, make sure that your investments are on track. Just as one wouldn't basically cut your own hair, take out your own appendix, okay? Just partner with a financial advisor, someone who knows a little bit about tax, a little bit about tax on investments, that's their specialization, and at all times keep the goal in mind, which is financial sufficiency in retirement. And I think that we all know that structuring one's retirement right for tax is not a sprint, okay? It needs to start long before retirement, needs to be fine-tuned all the way, and it really is a long marathon, but one will get to one's goals eventually.
Thanks, Jenny. I think that was a great way to get to know the different taxes and without it being too heavy, especially as it was the last session before lunch. Back to you, Peter.
Thank you very much indeed.